Joining me is Chance Finucane, Chief Investment Officer at Oxbow Advisors. Now, we have the Fed meeting tomorrow, Chance. Let's just for a moment put aside what the Fed will actually do. I just want your thoughts on how you feel about all this. What do you think is the right move for the Fed? Pause or continue to hike?
It's a tough call. I think given that inflation is still at 6% and probably is only going to come down to about 4% before it stalls out at around 4 for a while, they probably still have to hike a little bit more, but you're seeing things break now in the financial markets. And what's interesting to us is the thing that caused the issues with Silicon Valley Bank and Signature Bank, those were treasuries and mortgage-backed securities. We didn't even get into the commercial real estate loans that have been given out by small and mid-sized banks. And we think that could be an area that you see weakness in the months or quarters to come. But what we pay attention to is a lot of the lending growth in the U.S. economy comes from small and mid-sized banks. The majority of commercial and industrial loans, commercial real estate loans, consumer lending, and residential real estate, those loans are coming from these sorts of banks that are having trouble keeping their deposits. It's not the mega banks like JP Morgan's and Wells Fargo's of the world. So if this is the situation we're in, you're going to see a slowdown in lending, which is going to further slow economic growth, which is going to make it a difficult environment for companies to generate any profit growth and keep up their margins. So I think right now it's just a very difficult time for the Fed. With inflation being higher than they want, they can't start to ease or try to assist the situation like they would have in the past 10 years.
And if we do get a 25 basis point hike tomorrow, does it change your investment strategy, or has your investment strategy changed over these past few weeks?
Our strategy really has not changed. What we've done in recent weeks as the volatility has spiked here is really paying close attention to everything we own in our clients' portfolios. And if we see anything that we think has an outsized risk and not a whole lot of reward left to it, we're getting out of those positions on days that those securities trade higher, so that we're really making sure we're mitigating the risk in the portfolio. But this is the sort of outcome we've been anticipating for quarters through pretty much all of 2022. And we would expect that sort of high risk scenario to continue in the months ahead.
Right, and you make a good point. I mean, is that the name of the game right now, to eliminate risk, in your opinion?
Yeah, we believe it is. So you haven't seen asset prices get down to levels where it's in your best interest to start really getting a bit more aggressive and thinking more about the upside rather than the downside. You've seen some real big problems in a few isolated areas of the market right now. But if you look across all the different sectors, things are still pretty fairly valued, if not a bit overvalued. So with the decelerating economy and some more issues happening in the financials part of the market, it's really not best place to be thinking about upside or opportunities. You'd much rather be focusing on staying defensive and waiting for a better opportunity down the road.
Where do you see safe spots in the market?
So what we've noticed, we've put some allocation into gold royalty businesses or gold miners. That's been an area that offers some diversification, and on certain days when everything else in the market is going down, they can trade higher because it's a relative safe space to be. We also think there's still some opportunities in the healthcare sector. So we own a few healthcare insurers that are trading at reasonable multiples. And then if you're looking for yield, there are still some areas that don't necessarily offer a lot of growth, but have consistent cash flow and pay a high dividend. So for our high income strategy, we recently purchased positions in names like Verizon and Kinder Morgan that pay a 7% dividend yield. And we think that dividend is sustainable, and you're buying at a valuation that's below its historic average. So we think that's a relative safe space to be as the rest of the market is going through a choppier environment.
All right, thank you very much, Chance. A pleasure having you on the show today.
Thanks, Don.
If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.